Hello everyone, welcome back to the channel. This is Fair Value Finder, and today we're taking a look at PDD Holdings, ticker PDD. This is another Chinese company, Pinduoduo, and it's a similar story to what we've seen. Coming up with a fair value of $175, current value of $128. So $50 undervalued. That's not quite 30% undervalued, but close to it. And it's just the fear of China. China is becoming a world superpower. They're likely going to surpass the US, and the US really doesn't like that. Retaliating in many ways, specifically tariffs. There's fear of Chinese companies getting delisted on US stock exchanges. But if you think that that's all just a conspiracy theory, essentially, then these companies are definitely worth putting some money into. I know Alibaba has paid off pretty well. I'm up a few $1,000s on that one, and go back and watch that video to see what I said about it. I thought it was half priced, and the market's starting to realize that it was severely undervalued. Now, this one's not quite as bad. Looks like I said about 30%, just about. Based on the thesis that we have here, which we'll go through, 2.5% annualized growth. You're looking at a 3-year return of 37%. Very, very tiny growth in the actual fair value. And in 5 years, 43%. So you are overperforming in the 3, underperforming in the 5. It's because it's super undervalued now, but it is underperforming the market in growth. So with all that, let's get right into this one. It should probably be another quick one. Earnings yield looks incredible. Looks like we'd want to see $6.41 per share in earnings, and analysts are projecting significantly more than that, $14.51 in 2025, $12.08 in 2024. Now, it was a little excessive in 2023. So growth-wise, this number is looking off down here, but we don't really use that. It's calculated based off the revenue growth and the share count. Cash flow yield really high, 37.8%, usually in the 37s. So great cash flows, no dividend. ROE looks really good, 32%. Debt to equity, not a concern, 0.86. So that ROE is legit and it's very good. ROI, 6.41. Could do some better investing. We've seen a lot worse. Most companies we've seen have had worse, so that's not too bad. ROA, assets are getting some nice returns, 17.25%. I like to see that. Gross margins, incredible, 63%, usually 68%, so they are down a bit. But the net margins are up 24.24, usually around 11. Revenue has been growing like crazy, but analysts are projecting a pretty big pullback in this one, where they're projecting a drop of 77% this year and 45% the following. So if we take a look at the metrics page over here, they're projecting revenues to go back to 2020 levels, which is a little crazy. Now, I'm going to double check this live because I'll show you how I typically find this information if you're not super familiar with the channel. Yahoo Finance, a nice free tool. And Pinduoduo is our stock here, PDD Holdings. So PDD Holdings is our stock. We go to analysis to see what analysts are saying about it. And we see that they are saying 57.45 billion for current year revenue and 73.57 for next year's. So it looks like they rose next year's expectations a little bit, nothing too drastic, but still relatively in line with what we have here. So the only thing that we can really do is go 46% drop in revenues on this one. Share count, they issue shares, not really something we like to see, 3 to 4%. So we're going to go with 4%. 3.5 might be even more fair, I guess. We can give them the benefit of the doubt here. Cash flows have been growing like crazy. Yield is in line with the historical. So we cannot expect growth in the cash flows if the revenues are dropping the way that they are. So we're going negative 40% there. Even at negative 40%, it's putting them at a 64% cash flow yield in 5 years. So we need to drop that more. Maybe even outpacing. I think that's a bit more reasonable. All right, now things are really changing. It is no longer worth purchasing at today's price. If you think that analysts are correct about these revenues and the cash flows move in line with that, because there's a lot of value coming off those cash flows. Now, assets, 2-year growth, 24%, 1 year, 47. We're going with 24 for the thesis on the lower end of that. Could go higher. Liabilities, 14.88, essentially 15, and 35%. So we could go with something more in the realm of like 30 and 20, and it would make it. And then at that point, you're essentially buying the stock at 3-year out valuations with a 6% annual decline, which is not good to see. So I want to take a look at how everything is trending here. I mean, there's some great growth in those revenues. I am surprised that analysts are expecting such a huge drop. But I think PDD Holdings is one of the companies that China essentially broke up on their own and split up into some of their subsidiaries. 2020, they weren't really making any money. They've been on a good trend since then for the net profit, and EBIT's been pretty good too. Gross profit has always been stair-stepping upwards. Balance sheet, we see some great growth there in the assets, tangible assets looking good as well. Liabilities, we also see really big growth. Tangible book value outpacing the liabilities in 2023. That's really impressive. And then cash flows, again, a peak and coming back down to levels. I think 2023 was just an exceptional year for them, and we can't really base things off of that. So this is pretty reasonable, these cash flows, back to levels we saw in 2021 and 2022. And they don't pay a dividend. So if we take a look at everything graphed out real quick, we can see where things are trending. So the lowest one here is the earnings. Hit a peak in 2023, coming back down. Analysts are expecting lower earnings and lower revenues, so that makes sense. Cash flows, very similar motion, just more exaggerated and much higher. Everything has a really similar motion. It looks like the earnings, the fair value, and the cash flows all hit a peak in 2023 and are on a big decline right now, while the balance sheet and the actual share price are slowly climbing up. Looks like the share price bottomed out in 2022 and has been on a decent uptrend since then. I'm surprised that it wasn't a lot higher in 2023, where all of the other metrics took a huge jump upwards, but that's part of the fear of them being a Chinese company. We can go back to our summary page here and try and see if there's another scenario that might make sense here. I mean, if they could just hold the revenues flat, this would be a totally different story here, because we'd be looking at revenues and cash flows holding flat. 10% growth, so growth in line with markets. At today's price, you'd be looking at double market returns in the next 3 years and almost the same in the next 5 years, but not quite. Assets, I'm going to take this back down to the lower end. Liabilities, hold it at 20. Like, I don't really see an insane growth scenario here. And that's probably mostly related to these revenues. If those started to go up again, even 5%, and the cash flows move not quite in line, then we're up to 8.2% average annual returns. So I am not too crazy about this one. Analysts don't seem to believe in it too much. Kind of a realistic scenario, at least based on analyst projections, is it's priced at its 3-year out valuation. And it is a company on the decline. If you don't believe the analysts, you might be able to get some market returns and have market outperformance in the next 3 and 5 years, but it's kind of a gamble, kind of a risk. A company like Alibaba is already on its way up and has much better fundamentals, but I do not see that in this case. This is probably not going to make the watch list. We might check back in on it down the road, but this one's not for me. So I want to thank you guys for watching. Please like and enjoy the video. Comment what other stocks we should take a look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.